What does it actually feel like to go from nothing to $100 million? Not the highlight reel, not the Forbes profile, not the TED Talk where everything sounds clean and inevitable in hindsight. The real journey, the 3 a.m. bank account checks, the payroll you almost couldn't make, the moment you realized the person you used to be could no longer take you where you needed to go. Because here's what nobody tells you about building extreme wealth. It doesn't arrive all at once. It doesn't reward the smartest person in the room. It doesn't care about your degree, your connections, or how hard you're willing to work. It arrives in stages. And each stage has its own rules, its own traps, and its own version of the person you have to become just to survive it. Most people never make it past stage 2, not because they lacked talent, because they didn't understand the game they were actually playing. Today we're walking through all of it, dollar by dollar, stage by stage. And by the end of this video, you'll see money, wealth, and the entire concept of building something from nothing in a way you never have before. Let's start at zero. This is where almost every CEO story actually begins, not with a vision board, not with a mentor in a tailored suit handing over the keys to success, with a problem that needs solving and not enough money to solve it properly. At this stage, you are not thinking about wealth. You are thinking about whether this idea in your head is worth the risk it would take to pursue it. And that question, is this worth it, is the first real test, because the answer is never obvious at the start. The future CEOs who made it will tell you honestly, they didn't know it was going to work. They believed it strongly enough to act anyway. Most future CEOs at this stage are still employed somewhere else, building at night, testing on weekends, having quiet conversations with potential customers that their coworkers know nothing about. The first $10,000 in revenue, whether it comes from a first client, a product someone actually paid for, or a service you offered before you even had a name for the business, that number matters less for what it buys and more for what it proves. It proves the market will pay you for something. That sounds simple. It isn't, because most people spend years, sometimes their entire careers, building things they think people want without ever forcing themselves to find out if anyone will actually open their wallet for it. Getting paid for the first time is a psychological event, not just a financial one. It tells you something the business plan, the spreadsheet, and the pep talk from your friend could never tell you. It tells you you're onto something real. Now things get interesting. And by interesting, I mean genuinely terrifying. You've left the job, or you're about to. Revenue is coming in, inconsistently, unpredictably, but it's real. And this is where most entrepreneurial stories quietly end. Not because the idea was bad, not because the founder wasn't talented, because they ran out of runway before the idea had enough time to work. There's a brutal statistic that hangs over every new business at this stage. According to the US Bureau of Labor Statistics, roughly 20% of new businesses fail within their first year. By year 5, nearly half are gone. And the number one cause isn't bad ideas, it's cash flow. You could be profitable on paper, genuinely profitable, and still go broke because your biggest client pays on 60-day terms and your suppliers want payment upfront and payroll is due on Friday. This is the gap that kills businesses that should have survived. At this stage, cash flow is not a finance concept, it's oxygen. The CEOs who survive this stage learn one skill above everything else. They learn how to buy time. They negotiate payment terms they were too intimidated to ask for before. They stretch invoices. They take on a consulting engagement they didn't plan for because it keeps the runway alive for another quarter. They make the boring, unsexy financial decisions that nobody talks about in startup podcasts. There's no glory in this stage, no press coverage. No one is writing articles about the founder who managed to get net 60 terms extended to net 90 to avoid a cash crisis. But that move, that quiet, unglamorous move, might be the one that kept the entire company alive long enough to become something. This is where character gets built, slowly, painfully, and completely without applause. Crossing $100,000 is the first time the idea stops feeling like a bet and starts feeling like a business, but it comes with a cost nobody warns you about. The moment you have employees, real people depending on a paycheck that has your name behind it, the stakes of every financial decision change completely. Here's the specific thing that separates the CEOs who make it through this stage from the ones who don't. It's not strategy. It's not product. It's not even talent. It's the ability to see a cash crisis coming 30 days before it arrives and do something about it while there's still time to act. Most founders find out about a cash problem the week it becomes a catastrophe. The invoice that didn't come in, the deal that fell through, the unexpected expense that wiped out the buffer they thought they had. The CEOs who build past this stage develop a financial early warning system, not a complicated one, just a simple, obsessive habit of knowing exactly what's coming in, what's going out, and where the gaps are before the gaps become emergencies. They also learn something counterintuitive about revenue at this stage. More customers doesn't always mean more safety. A founder with 5 clients paying $20,000 a year is more exposed than they look, because if one client walks, they just lost 20% of their revenue overnight. The CEOs who survive stage 3 understand concentration risk early. They diversify their customer base with the same urgency that an investor diversifies a portfolio. By the time they cross $1 million, they're not just bigger, they're structurally stronger. And that foundation is what makes everything that comes next possible. Here's where the story gets counterintuitive. Crossing $1 million, whether in revenue or personal net worth, should feel like the finish line, like the moment you can finally exhale. And for about 48 hours, it does. Then the realization sets in. You built something that works. Now you have to build something that scales. And those are 2 completely different problems, requiring 2 completely different kinds of people. The skills that got you to $1 million, scrappiness, hustle, personal relationships, the ability to do 12 jobs at once because you couldn't afford to hire anyone to do them for you. Those exact same skills, the ones that saved you in the early stages, will actively destroy you on the way to 10 million. Here's why. At $1 million, your involvement in everything is an asset. You're the one who knows every customer, every vendor, every process. That closeness is what made the product good and the service reliable. At 10 million, your involvement in everything is a bottleneck. Every decision waiting for your approval. Every hire filtered through your gut instinct, every strategy shaped by your personal preferences rather than what the market is actually telling you. The most dangerous person in a fast-growing company is very often the founder, and the CEOs who break through from 1 million to 10 million understand this. They do something psychologically brutal. They fire their old self. They build systems instead of improvising. They hire people who are better than them in specific areas. And they actually let those people work. They stop being the most important person in every room and start building rooms that don't need them in it. There's a term for this in organizational psychology: founder's transition, the shift from operator to architect. Research shows that the majority of founders who successfully scale past $10 million in revenue cite one defining move above all others: the first senior hire they made who genuinely intimidated them. Not a loyal friend, not someone safe, someone who was better. That hire is the moment the company stops being a reflection of one person and starts becoming something bigger. Most people can't make that move. The ego won't allow it. The ones who can, they're the ones we're still talking about 20 years later. At this level, the CEO's personal financial picture changes completely. Because now we're not just talking about revenue. We're talking about wealth creation, real wealth, the kind that compounds, the kind that survives a bad year, the kind that gets passed down. A CEO running a company valued at $50 million with a 20% ownership stake is sitting on $10 million in paper wealth. Before a single exit, before a single acquisition offer lands in their inbox. And this is where smart CEOs stop playing the revenue game and start playing the structure game. They hire a CFO with a background in M&A, a tax attorney who specializes in founder exits, a wealth manager who understands equity compensation, not just stock portfolios. And they do this before they need to, years before the exit, years before the acquisition conversation. Because here is the number that should wake every entrepreneur up at night. The average founder who sells a company for $50 million, depending on how their equity was structured, what class of shares they hold, how much dilution happened through funding rounds, and what state they live in, can walk away with anywhere from $8 million to $35 million. Same exit price. Completely different outcome. The difference isn't luck. It isn't negotiation skill. It's structure. Decisions made 3, 4, 5 years before the deal was even on the table. This is the part of wealth building that doesn't fit on a motivational poster. It's not about earning more, it's about losing less. The wealthy don't just make more money than everyone else, they have better architects around them. People whose entire job is to make sure the wealth that gets built doesn't quietly disappear into taxes, poor deal structures, and decisions made in haste. At $10 million to $50 million, the game is no longer just about growth. The game is about protection. There's a concept in wealth psychology called FU money. It's the number at which you could walk away from everything. The company, the board, the investors, the obligations, the early morning calls with people you never liked, and never have to work again. For most people, that number lands somewhere between $10 and $30 million, depending on lifestyle, location, and how you define freedom. But the CEOs who've crossed $50 million will tell you something interesting. The freedom didn't feel the way they thought it would, because by the time the money arrived, they had already redefined what they were working for. The early motivation, the fear of failure, the hunger to prove something, the need to build something that lasted, that had been slowly replaced by something quieter, something that looks, from the outside, a lot like purpose. At this level, $50 million to $100 million, the CEO is no longer the same person who started at zero. The board dynamic has shifted. Outside investors may be involved. The company may have gone through a fundraising round, a near acquisition, a restructuring, or all three. The CEO has been tested in ways they could never have anticipated at the beginning. And the wealth itself has become complex in ways that early-stage entrepreneurs don't think about. At this level, a CEO's net worth is rarely sitting in a bank account. It's spread across equity stakes, real estate, private investments, deferred compensation structures, trust vehicles, and illiquid assets that look impressive on paper and are impossible to access quickly. Managing $50 to $100 million in wealth is itself a full-time job. The CEOs who handle it well treat it with the same rigor they brought to building the company. The ones who don't, who assume that having the money means they automatically know how to manage it, statistically, many of them end up worth significantly less a decade later than they were at their peak. There are documented cases of founders who sold companies for $80 million and were nearly broke 15 years later, not because they were reckless, because they didn't understand that building wealth and preserving wealth are two completely different disciplines. And the second one is harder. Let's talk about what crossing $100 million actually does to a person. Because the version of this story most people have in their head looks something like this. The founder wires the money, pops champagne, buys the house, buys the car, calls their parents, finally exhales after years of grinding, and lives happily ever after. That's not what happens. What actually happens, according to nearly every founder who has been through a major exit, is a period of profound disorientation that nobody prepares you for, and almost nobody talks about publicly, because the goal they organized their entire life around for the last decade is suddenly gone. The urgency, the daily sense of purpose, the identity of being the person building the thing. All of it disappears the moment the wire clears. And what's left is a question that the money cannot answer. Now what? There's a name for this in clinical psychology: post-exit depression. It affects a significant number of founders after major liquidity events, and it almost never makes it into the interviews and profiles because it contradicts the story we've all agreed to tell about success. But here's what's interesting about the CEOs who cross $100 million and don't go through that spiral. They all built something specific before the exit that most founders neglect entirely. They built a life that wasn't defined by the company, relationships that existed outside the office, interests that had nothing to do with revenue, a clear sense of who they were beyond the title on the business card. Because when the company is gone, and eventually, one way or another, it always is, the people who come out whole on the other side are the ones who never let the company become the only thing they were. The $100 million doesn't change who you are. It amplifies who you already were. If you were anxious before the money makes the anxiety louder. If you were generous before the money gives that generosity a much bigger stage. If you had nothing outside the company before the exit leaves you with nothing but the money. And the money, it turns out, is very bad company. Here's what this entire journey actually teaches you about money and wealth. Every stage has a different enemy. And if you don't know what you're fighting, you can't win. At $0 to $10,000, the enemy is doubt. The internal voice that says the idea isn't good enough, the timing isn't right, the market won't pay for it. The only weapon against doubt is action. Imperfect, uncomfortable, early action. At $10,000 to $100,000, the enemy is cash flow, not competition, not market conditions. The gap between money owed to you and money owed by you. The weapon here is financial discipline. Unglamorous, unrelenting, non-negotiable. At $100,000 to $1 million, the enemy is concentration. One big client, one revenue stream, one point of failure that can unravel everything overnight. The weapon is diversification of customers, of income, of risk. At $1 million to $10 million, the enemy is ego. The belief that the person who got you here is the person who can take you there. The weapon is self-awareness and the courage to hire people who make you feel slightly obsolete. At $10 million to $50 million, the enemy is poor structure, wealth being built without the architecture to protect it. The weapon is the right team around you, not yes people, but genuine experts whose job is to tell you what you don't want to hear. At $50 million to $100 million, the enemy is losing your identity, letting the company become so completely who you are that when it's gone, you're gone with it. The weapon is intentionality, building a life, not just a business. The people who make it all the way through aren't superhuman. They're people who identified the right enemy at the right stage and fought it with everything they had. So wherever you are right now, whether you're still at zero, whether you're somewhere in the dangerous middle, whether you're already past $1 million and starting to feel the growing pains of the next stage, the map exists, the enemies are known, and the people who've walked this road before you, the ones sitting on the other side of $100 million looking back, every single one of them will tell you the same thing. It was harder than they expected. It took longer than they planned. And it was worth it in ways that had almost nothing to do with the money, because the real prize was never the number. The real prize was who they had to become to reach it. If this video changed the way you think about money, wealth, and what it actually takes to build something real, share it with someone on the path. Subscribe if you're not already part of this channel. We go deep on these topics every single week, and we're just getting started.